Hello, participants, and welcome to this course, the A to Z of Practical Microfinance Banking. It's a topic I really know you enjoy. People are into microfinance for various reasons. I can tell you a lot of people don't even know why they are in. I recommend this course for beginners. I also recommend it for professionals in the microfinance industry. So I'd like you to I'll take your questions as they come, but I'll just want you to follow me with everything we're going to be doing today, okay? So the course is A to Z of Practical Microfinance Banking. And the first question I'm going to be asking you is, what is microfinance banking? Microfinance refers to the provision of small-scale financials to individuals or groups who typically lack access to traditional banking system. Microfinance is not just about lending, and this is where people get it wrong. This is the misconception that a lot of people are carrying their minds before they even venture into the microfinance business. Theory without evidence is just philosophy. This is why I'll be discussing the practicality of microfinance banking that works well, not just microfinance that work well. But first, let me share a detailed real life story of an individual who built his lending business in Nigeria, practically, using his money was able to raise, I'm not going to be using the person's name for privacy, okay? So let's just say Tunde is a 31-year-old accountant, okay, who understood financial statements better than most. Now, this is the difference. You need to understand the books of accounting. If I say the books of accounting, the customer's book of accounting, you understand the customer's cash flow, you understand the customer's financial statement, you understand the customer's income statement, which is on a profit and loss, very, very well. So before he gives them loan, he makes sure he understands what their cash flow is and how they make money. So, this kind of person. So he had no capital, but he had built a network of 200 plus true LinkedIn contacts where, young professionals, let's say age 20 to 40. Mostly, let's just take for Abuja civil service and the private sector in the economy. Many of whom complain about loan sharks and payday loan that are charging up to 30% per month. Microfinance is not about charging the highest. I remember I did a video on peer-to-peer lending, and one person was saying, I'm teaching how to make people charge more for microfinance. It's way more than that. I use that as an hypothetical structure to understand how microfinance work. Not I'm saying that you should charge high. Okay, so let's just say you register the business name to the financial service under CAC. He created a simple Google form for an application and a separate WhatsApp. Just to make sure he manages his customer. In this case, he's not building something big. He's just trying to construct a system whereby he has all his customers there and they're able to communicate. Okay, so he announced his network. I'm launching a salary advance service. If you have salary, I need a big loan, as let's say 8%. It is not what I'm recommending. This is hypothetical. 8% flat per month. Is 8% not better what you get from loan shark for 30% per month? That's fine. So he's telling them, apply here. Instead of you getting a 10% from loan shark, I can give you at 8%. Okay, flat. So if you have to invest 25% per annum return, sign up here. If you know that you want something, go sign up here. So within 1 week, we had 40 borrowers. 40 borrowers applied. 12 investors signed up, totaling 3.2 million available in capital. So what did Tunde do? Tunde's complete advantage was his accounting background. He verified the employer's letter, he looked at their payslip, he understood their bank statement. Things made up did not do true algorithm, but often miss, when they are calculating. So his very first circle, his default rate was just 2%. One missed payment out of 45 because he was closer to his people and he was able to manage their loans. Now, what am I trying to draw out of this? It's not about the money Tunde is making now. Tunde was able to meet the needs of people as at when due at the right time. Okay? Yeah, isn't it a sweet story? I tell you it is, but it can be way more complicated than that. Microfinance, am I trying to say, is about serving a need. Okay? It's about serving a purpose. It's about meeting real need. So if I ask again, what is microfinance? National and international economies cannot function without proper financial system and financial institutions. They are crucial to the national allocation of resources in modern economy. They mobilize deposits and make these funds available to borrowers. The financial system comprises of a set of complex and closely interconnected financial institutions. We have market, we have instruments, we have services, we have practices, we have transaction, we have main function. We just have quite a lot of things. The main function is to act as an intermediary for passage of funds, which is very, very important. Let me give you a brief highlight. We have information, okay, channels, which is key to any surplus and deficit units. The surplus units, we have the private and the household, and we have, the investors and borrowers on the demand side. Okay, so what happens here is money plays hand. You have money going from the demand sector, you have money going from the supply sector to the demand sector, and this is more functional in the financial operations market. We will come back to talk about the financial operations market, but right now we just need to understand that these are key players in the system. So what do the suppliers do? The suppliers of money capital on one side are primarily private household investors. They do not consume all their income at a certain point in time, and instead they save a certain portion for future. Okay, frequent unforeseen expenditures are things that they plan for. They are hence called savers of financial surplus. Hope you understand that. Those demanding money on the other side are companies facing basic problems. The investment required for production and the outlays of funds until it precedes the influx of funds from the sale of their products. So, by the nature of their activity, they require capital and are termed financial deficits or surplus units. Okay? In theory, if there are no banks, supply and demand for funds will reach equilibrium. That's the point at which demand and supply meet. Now, look at this. In direct contrast between financial surplus and deficit units, this equilibrium does not, however, come about in reality, because fund providers and those demand funds usually cannot meet each other in person. There will never be equilibrium. I need money, I have surplus, and they come and say, oh, since I know you have money, let us meet. This is where microfinance bank comes in. Consider a businessman who requires a loan of 10,000 naira. Could he possibly search, among hundreds of small savers to find and raise a loan? No, it's not possible. He has to do that engineer, and that's why microfinance is important. Direct contact between savers and borrowers will necessitate making an enormous effort. You have to go here and there, and this will lead to high cost for both parties anyway. So the likelihood of finding just the right person is very small. And this is the reason why you should understand microfinance banking in its entirety. Will it be wise to talk about microfinance without understanding microfinance history? No. Microfinance is not a new thing, as people have assumed. This is really the generations of microfinance staff that we have now. Informal microfinance has been around for hundreds of years. In almost every corner of the world, people have long been forming groups to put their savings and give loans to their group members. Okay, be it for business, wedding, funeral, or something else. Example of time-honored streams include the cheat funds. I think you can get that in India. We have the Hill in China. We have the Arizan in Indonesia, or the Palawan in the Philippines. Okay, Pawning is another form of microfinance that has been in use for centuries. The birth of microfinance in Europe dates back to if I'm not mistaken, that should be the 16th and 17th centuries. The so-called Irish loan funds emerged in 1970s as charities. Okay, initially financed from donated resources, they provide interest-free loan to their member. They were also replaced by financial intermediation between savers and borrowers. Okay, so loans were short-term and installments weekly. Money just have to come in weekly so that you can rotate. Prayer monitoring was used to enforce repayment in those days. But today's microfinance can be traced back to Germany's credit cooperative movement, which began in response to famine in the 1850s. Let's talk about the Sparkers and Savings Bank. They were established by the German state to mobilize and protect small deposits of the public. Okay, so in Germany, this former microfinance institution now account for around 50% of banking assets globally. Let's talk about the British microfinance banking system. The British introduced cooperative credit groups into colonial India. Then, they were in charge, they were in power. So, including what is today Bangladesh, home to Ganon banking, the world's most known microfinance institution, a name synonymous with Professor Mohammed Yunus. We all know, if you're a microfinance professional and you've not heard of him, you don't know him, you need to go and dig some history about Professor Yunus. I'll stop there about the history so that we can focus on some key areas. There's quite a lot to discuss about the history of microfinance, but we're going to be stopping there. Let's look at the pillars of microfinance banking. The pillars of microfinance banking, there are 5. But there's no way we're going to be talking about the pillars of microfinance bank before talking about the elements and the pillars of a microfinance bank. The first one is the microfinance institution. Okay? I'm not talking about the pillars of banking, I'm talking about the pillars of microfinance bank. The first one, like I said, is microfinance bank. The second one you need to look at is the engagement and the partnership. What does the engagement do and what does the partnership do? The engagement is to look for the active poor, engage them, give them resources, and make sure that they are viable, ready to do business so that there will be economic development, which is the last thing we'll be talking about. Then in the partnership model, you should look at those that you can partner with to make sure microfinance strive in your country. Whom can you work with? Now let's go back to the engagement. In the engagement, you need to make provisions like micro savings, micro credit, and micro leasing. Now, when I said partnership, there are some things you can't do by yourself. A very good example is micro insurance. Microfinance bank and microfinance insurance are 2 separate institutions. So you need to get partnership to make sure you sign up insurance policies for your microfinance customers. Okay? The other part of that is micro remittances. Yes, if you are a microfinance that offers digital services, you might be able to offer transfers on a local scale, but you'll not be able to do that on an international basis. So you need partnership with banks, with corresponding banks, and with different kind of money transfer institutions to make sure that is possible. Okay? Then let's look at who all these services, who are they made for? We have the small businesses, we have the household, and we have the active poor. All this leads to one thing, so that we can have economic development. Okay? Now, when we have this economic development, it has given us the 5 pillars. Number 1, in the 5 pillars we are looking at is the providers, which is the microfinance bank. The microfinance bank are the providers. Then we also have the processes, which is on the engagement and the partnership. Then we have the core component, which makes up the 5 services you are offering. Then we have the beneficiaries, like I said, which is the small businesses, the household, and the active poor. And you have the impact, which is the economic development. These 5 are the pillars of microfinance banking: the providers, the process, the core components, the beneficiaries, and the impact. Now, we agree, we don't have one microfinance bank. So we have it all scattered in different nations, in different sectors, in different economies, in different societies, in different backgrounds, just everywhere. Now, microfinance don't just operate. We have two distinct regulators which act as regulators to this microfinance bank. Let me use Nigerian bank as a typical example. That's where I am. We have the Central Bank of Nigeria and we have the state government. The Central Bank of Nigeria regulates microfinance bank, but don't regulate microfinance institutions. Okay? So who regulates the microfinance bank? Like I said, it is the Central Bank, while the state government regulates the microfinance institution through the courts and through the Ministry of Interior in some states, let's say like Lagos. But for other states out of Lagos, I think the courts just take care of it. Okay? Now let's look at objectives of microfinance. Microfinance is not just created for the fun of it. A lot of investors believe microfinance is just for making money. Microfinance is majorly for three specific purposes. We have the profit motive, we have the social motive, and we have the environmental motive. So the first thing we need to know is that we have 10 objectives in microfinance. Number one, the financial inclusion objective. We have the poverty alleviation. We have women empowerment. We have savings and asset building. We have shock resilience, which is handled by the insurance. We have entrepreneurship and self-development. We have financial sustainability. We have community development. We have credit issues and discipline. And we have the very last one again, which is economic development, which is key. For 90% of our discussion will always take us back to why we are discussing microfinance now. Okay? Now, remember, how did we get here? We talked about economic development, which if you trace back, leads us to who are the beneficiaries of the economic development. We also looked at what makes up the core components, of these services. Then we talked about process, and we talked about the provider, which is the microfinance bank. Don't forget the 11 principles of microfinance bank. Severally, I've trained, I've done a lot of trainings, and I'll ask, have you heard about, during my training and facilitation, have you heard about principles of microfinance? Say, no, I've never heard there's a principle of microfinance, not to talk of 11 principles of microfinance. And I laugh and I said, no. That's not right. There are principles in microfinance bank. Number one is that in no particular order anyway. But number one, you should know that microfinance is not just about lending. It's about variety of services. And that was what we saw with the products that we have in micro savings, micro loans, which is lending, micro leasing, micro insurance, and micro transfer. Microfinance, you have variety of services that cater for the services and needs of the populace. Then also know that microfinance is a powerful tool against poverty. This is what I've seen a lot of people. Commercial banks, the regular commercial banks don't easily grant loans to everybody. So this is why microfinance was created, to make sure that the active poor have access to finance. Then microfinance is also to build systems for the poor. Let them understand that they have their books of account, they have their balance sheet, they have their income statement, they have their cash flow, and they should, once they understand it, it will help them to build the structure and how they manage their funds, inflow, and resources. Okay? Microfinance is also to help financial sustainability. Once the economy is growing as a result of trade and commerce, it's growing as a result of increasing GDP of the country. So if a country is financially sustainable, it helps the country to go better. Then it's also given to permanent local institution, which means local government will grow. As the federal government is growing, the state government is growing, the local government also has room to grow. The sixth one is that credit isn't always the answer, and this is my favorite one. I'll tell you. Everybody wants to give out loans. But for me, loan is not always appropriate. There are some customers that will come in. You should be able to advise them that, no, you don't need loan. What you need is to save. Okay? So I always know that loan is not always appropriate. Number 7 is that you should be aware of interest rate ceiling. What do I mean by interest rate ceiling? If you cap an interest rate for all microfinance banks to work with, it might not work with them because where they get their fund differs. Okay? Their borrowing power differs. Their borrowing route differs. That's why when we look at the source of fund and use of fund, you will understand. So interest rate ceiling can actually damage the microfinance bank because of their source and use of fund. Number 8 of it is that government should be an enabler and not a competitor. When you have microfinance banks being owned by the government, you know there's going to be a little bit of biasness. There's going to be a little bit of favoritism played there. So government, as it is, should be an enabler and not a competitor to growing microfinance. Another thing we should know, which is number 9, is that donors should complement markets. Donations, just like subsidies, should be used to build capacity system, not to crowd out private capitals. Okay, so it should be used for what it was meant for. Number 10 is that microfinance is capacity. In its capacity is should not be a constraint, should not be a bottleneck. Microfinance needs skilled institution regulations to partner with so that they move. Okay, so capacity should not be a constraint for the microfinance bank, but it should be something that should help them grow. The level 1 is that there should be financial transparency. There should be accurate standardized data on financial and social performance, which is imperative for every borrower. Okay, so there should be financial transparency in the system. Okay, let's assume the government creates an interest ceiling and say all microfinance should operate with a 5% interest rate flat. At a stage, you are giving concession to other MABs. There's no transparency in the system. Okay, so if you understand these 11 key principles, it will help you. Mind you, this 11 principles was developed by the consultative group to assist the poor, the group of financial institution that seeks for the economic development of growing nations. Okay, so they were able to draw out these 11 key principles to make sure that microfinance does not die in its infant. Okay, now we look at providers of microfinance. Remember, we were talking about only microfinance bank. Microfinance bank is not the only institution that provides funds. This institution cuts across many. We have commercial banks. We do have some commercial banks that are really doing good retail loans. Then we have the microfinance bank that we've been talking about. We have the cooperative societies, and we also have the informal money lenders. They account for a large number of people in the societies that are trying to make sure that the economy grows. Yes, you might not have an accurate number of those that are operating in the informal money lending sector, but I can tell you they play a big role when it comes to dispersing of funds. Now the process is easy. We have an ecosystem where all financial institutions operate. What do? There should be supply. This ecosystem supply funds, and these funds get to the hand of borrowers. If you get to the hand of borrowers, they must return. Once they return, it goes back into the system, which is the financial institution. Okay? What does the financial institution do? They return to the savers, those that brought in the money, because that's not their money. Then what the savers do, they leave. Eventually, maybe they make withdrawals, they pour it back, supply it back to the system. So the process is as easy as this. I know some people will say, microfinance back money is federal government money. It doesn't work like that. Okay? The core components. We talked about 5 earlier on. We talked about micro savings, micro credit, micro leasing, micro insurance, and micro transfer. You know, when we talked about the partnership and engagement. Don't forget, for the engagement, we engage them on the micro savings, micro credit, and micro leasing. But for the partnership, we get the micro insurance companies and get transfer remittance company. Now, what I did not talk about in those core components was micro housing and micro pension. This is new in some development countries. I don't want to go deep into that, but just know that it's what is going to become the next in thing in microfinance. There are going to be a lot of micro products that are going to be coming out that are being organized and offered on large scale basis. But as we speak, governments of countries are trying to see how it's going to be working out for a lot for the populace. Beneficiaries, we talk about small businesses, we talk about the household, and we talk about the active poor. All this is for one purpose: economic development, which will make impact on everybody that is enjoying it. Now let's look at what economic development, the role it plays in the society. So economic development grows financial inclusion. It encourages financial inclusion. If financial inclusion is handled with a lot of priority, it will reduce poverty. Okay? Prior to now, women were not allowed to actively engage in business. But I can comfortably tell you that women hold their home in esteem, that they support their families to take care with their household expenses. That's why women empowerment is very, very important. What does this lead to? It creates entrepreneurship roots. Everybody is doing something. Everybody is selling something. Everybody is transacting. Everybody is buying. Okay? Don't forget, the money coming back from the financial system goes back to the financial system, creates economic development, which is key. Okay? Social impacts and benefits. We talked about poverty eradication, right? Now, what does poverty eradication do? One of the benefits of microfinance is that it reduces poverty. They involve economic and social strategies to permanently lift individuals and communities out of poverty by increasing income, increasing incomes, creating jobs, providing access to essential services like education, healthcare, and clean water through funding channels. I talked about women empowerment. I just have to pick this key because they are very, very important. Everyone gains control over their own lives with ability to influence social and economic environment. So microfinance achieve this by providing them with necessary opportunities, resources, education, confidence, and tools to achieve self-worth, pursue diverse paths, and participate fully in society as equal contributions to social and economic development. We will always keep talking about economic development. Yes, we did talk about job creation, and microfinance institutions generate new employment opportunities, which is a fundamental driver for economic growth and poverty eradication by increasing income and demand. A successful job creation strategy requires a holistic approach that includes skill development, matching labors, supply with demand, and promoting decent work in various sectors. Then we have the final one, which is financial inclusion. Excuse me. Financial inclusion being a catalyst for achieving 7 of the 17 sustainable development goals is what microfinance institution has taken up to achieve economic development. Financial inclusion means that individuals and businesses have access to the use affordable financial products and services that meet their needs, which are delivered in a responsible and sustainable way. What's the role of microfinance in economic development? Purpose. The number one thing is purpose. It aims to empower low-income household and micro entrepreneurs, particularly in developing economies, by giving them the capital and financial tools needed to start or expand small businesses. This is very, very key. Another thing it does is that it let them recognize the key principle, as in instead of relying on physical collateral like property or asset, microfinance always uses social collateral. This works for group, okay, more just to ensure repayment. Then if group is not involved, you can, that's why we have the 5 C's. You must use one to judge. It's either character, capacity, collateral, condition, and capacity. You just use key principle and know which one works well and which one works best. Then you need to understand the typical clients. Who are they? Small farmers, small household farmers, petty traders, artisans, women-led businesses, and rural communities. Then you need to understand the institution. Retail loans are delivered by microfinance institution. What is microfinance institution? What's an NGO? What are cooperatives? What are saving groups? Rural banks? Then you need to understand all this. Microfinance institutions are regulated by state government and not regulated by the central bank of Nigeria. Then the impact. Beyond credit, microfinance promotes financial inclusion, helps reduce poverty, and strengthens community development. Remember, we did talk about financial market operation, okay, or demand and supply. The suppliers, their main interest is to receive interest because they supply money through a channel. Now that we have this, know that they all come from financial institutions that provides money, resources. They both have something in common. I did talk about this earlier on. The source of fund and the use of fund. Who are the source of fund? The suppliers of the fund. They include the savers, the donors, and the investors that receive interest. Then on the side of the use, who are the users of this fund? We have investment. What is it for? We have for investment, we have for opportunities, and for basic private or family needs. They pay interest. Let's look at the microfinance typology. We have a microfinance institution that operates for a purpose. But there are 2 models that are currently being run till date. The first one is the brick and mortar, where everybody walks in and makes their transaction and go back out. Then we also have the e-business model, which operates more of the digital banking space. In the brick and mortar, you operate directly. It's a direct channel. There's no two way about it. You must walk into the bank to either make withdrawal or to access your loan, okay, which is practically what is being practiced. Then under the e-business, what do we have? We also have 2 routes. We have either the digital platform or the agency platform. What differentiates the agency banking and the digital lending platform? The digital lending platform, you don't need, what you need is an interface. But for the agency banking, you need station agent and mobile agents to interface directly with your clients. It means you need front-facing staff to make sure that you get along with your clients. All this as an administrative process, but the end point is to make sure that the ultimate consumer of a finished financial product gets it at when due. We'll be stopping here for today. What we are trying to do is for you to understand the nuggets of microfinance in its entirety. There's still a lot of things to learn, but I think you'll have more from us in our next episode. For those that are online, we appreciate joining us for this lecture. For the participants that are online, I welcome you and I enjoy you to make sure you have a good study with what you've learned today. Make sure you put them to practice. Whatever it is you've learned now might not be for now, it might also for the future. I encourage those online to subscribe to the Microfinance Arena channel, brought to you and sponsored solely by Leon Consulting Limited. Till I see you in our next episode. My name is Ari Onyema from Leon Consulting. Bye bye.